Let's see if I can get it going.
Did you guys get the quiz to work?
I couldn't get the quiz.
No, I couldn't either. Okay. Because when I click on it,
I'm unmuted.
says that the assignment can't be found. Is that what you guys had?
Yeah. So
I can't hear any of y'all, so let me. Oh, the quiz isn't working.
Correct.
Is that, Tanisha, did the quiz work for anybody else? Okay, well, I don't know why it was supposed to launch at 8:05, so we won't worry about the quiz. But why can't I hear y'all? Oh, I know why. Now, can someone say hello?
How you doing?
Oh, yay. I had to turn my volume on. I had it off last night. Easy, easy. Let's see. Oh my God. What is the gallery view? All right. Good morning. So the quiz didn't work for anybody, huh?
Right.
Y'all are sorry about that, huh? Well, I'll get it. I have no clue as to why. I'll check into it, later on. So we just won't worry about the quiz. I assume that y'all read the chapter. Yeah, let me type. Yeah, so the quiz isn't working. I'm getting a lot of chats about that. So everybody coming in, I know that the quiz, you see what's behind me? I have a whiteboard. Wait, let me answer this. All right, I'm trying to handle all the chats. Some are chatting privately about the quiz. So, were y'all able to, y'all saw the chapter 6 problems that I have uploaded? I assume many of you were able to work them. If not, work them, because we need to get those questions. Those are the questions that I put up, for y'all to work the end of chapter problems, as well as work the ones that I put up getting ready for the quiz. Okay. Those of you that aren't showing me your faces, I really appreciate seeing your faces. I really don't care what you look like. I'm sure your classmates don't, unless it's something, we don't want to see. But it is kind of cool seeing y'all. Hey, Lillian, how are you doing? Good seeing you.
I'm good. How are you?
I'm doing well. It's been stressful for all of us, but, with us getting ready to do this, but I feel like I'm pretty comfortable now with it. I've set up more office hours on, my LinkedIn for office hours. What I'm doing is, remember, I used to have office hours on Monday. Now I'm setting up my office hours on Wednesday, because it's in between the two classes. Obviously Wednesday is in between Tuesday and Thursday. So I'm setting them up on Wednesday. Again, if you can't meet with me during those time periods, be sure and email me, because I can, we can just set up a one-on-one, chat at whatever time that you can meet with me. I'm trying to keep it controlled, to Wednesday, because, but again, if you can't meet with me, then send me an email and we'll schedule a time to meet. Got my hair done yesterday. The blue is brighter. Also, one of the things that I'm thinking about one of the things that I'm probably going to do, it doesn't come out of Dr. Bostic's mouth, that EC word that I don't like. What is the EC?
Extra credit.
Extra credit. I don't like extra credit. But I think what I'm going to do with extra credit starting next week is for students that attend the class live, and I will put an email out, an announcement out about this, because those that aren't here live aren't getting the message. But those that are attending the class live, that I'm going to give extra credit to.
Thank you.
I think it's important for y'all to be here live. For me, so that I see how well that you're understanding, and I can answer your questions during the video for what you're not understanding. Whereas if I was just talking to a wall, I don't know what you're understanding and what you're not. So you will be seeing an announcement coming out about that. What I'll be doing to make sure that you're staying in attendance throughout is I'm going to send out questions throughout the class period. A question about what we're talking about, and it'll be in multiple choice for you to answer. And then your extra credit will be, if I send out 4 questions and you answer just 1 of the 4 or 2 of the 4, none 3, 4. So that'll be the way that I will handle that. Okay. Y'all ready to, class is supposed to start at 8:20 given the quiz thing, but I assume that with the quiz not coming in, that everybody's coming in. Good morning, Leighton.
Hi.
How are you doing this morning?
Good. How are you?
Doing fine. Sorry the quiz didn't work. I have no idea why it didn't work.
Okay. I was just about to tell you to make sure you knew.
Yeah.
Yeah, I was going to ask that too.
All right.
Yeah. So I don't know why, because I've launched quizzes from there before. So that one isn't my first rodeo doing that, but maybe I put 8:05 p.m. instead of a.m. You never know.
Yeah.
I will check it and see what's going on. So sorry about that. It was a 5-question quiz. It was scrambled. Everybody would get a different question about accounts receivable. So anybody, again, I'm going to reiterate to please work those chapter 6 practice problems that I uploaded. They will help you a lot with chapter 6. Before we get into chapter 7, there is one concept in chapter 6 that we did not talk about. There's no number crunching involved with it, but it is a very important concept that we see carried over into chapter 7. So go to page, part of your variable consideration in chapter 6. And it is on page 295. So if everybody can go to page 295. Are y'all pretty much quarantining yourselves in your home?
Yep.
Yeah,
Mhm.
but I'm going
Yeah.
home soon.
You're going home soon? Who's in the
Yeah.
dorm? Who is that?
Me.
Yeah.
I'm in the dorm now.
Yep, y'all in the
Going
dorm.
home today.
Campus pretty empty?
Yeah, it is.
Yeah.
Basically kicking us out.
Do what now?
They're basically kicking us out.
Oh, are they? Did they tell y'all to go?
Yeah.
I think,
Because they said if you leave,
go ahead, Daniel.
they said if you leave before March 23rd, you get like a 47% refund on your housing.
Okay, good. I had heard yesterday that they were going to be doing refunds. And guess how much that's costing the university?
A lot of money.
$10 million.
Wow.
God.
Yeah, $10 million is being refunded. So, that's tough. And the university does have insurance that would cover like things like if we had catastrophic hurricane or something, but it's with Lloyd's of London, but it doesn't cover this. So this is just right out. But anyway, look on page 295 in chapter 6. Okay. And at the bottom of page 295 is the time value of money. And we've already learned about time value of money. We understand that, $1 today is worth more than $1 tomorrow. Okay. What the time value of money in chapter 6 is addressing is if you have a contract And some contracts, a lot of contracts, can be custom contracts. And the seller will require the buyer to pay upfront. So you know that we've got deferred revenue, which is when we collect money front, and then as we earn the money, it goes out of that liability deferred into earned revenue. Well, if the time period, when you read that part of the chapter, the time value of money on page 295, what it's saying is if that time period between, if it's deferred revenue and you collect the money up front from the customer, if that time period is a year or more, then you must take into consideration interest expense or interest revenue, depending on which way that the money flows. So let me get to the board right here and show you what I'm talking about. I'll adjust my screen as necessary. Can y'all see the board okay? I'll have to work on the lighting.
Yeah.
Can you see it okay?
Yep.
All right. So if the seller collects 1 year before the revenue is earned. So if the seller collects 1 year before the revenue is earned, sorry, I just knocked over a table that had my book and all on it. So I got to be careful. My husband's going to probably come running in here. So if the seller collects the money from the contract 1 year before the revenue is earned, then in essence, the seller, so this would be, they would debit cash and credit deferred revenue when they collected the cash, right? Well, if it's 1 year between when they collect the cash and then they earn the revenue, then the seller has in essence borrowed money from the customer. And part of that contract, if you look on page 296, you can see the calculations of it. I am not going to require that you do the calculations, but you do have to understand the concept, okay? So if the seller collects 1 year before the revenue is earned, then in essence, the seller has borrowed money from the customer. And part of that contract will be interest expense. And you see the calculations on the, can y'all see? Because look, I even can tilt this thing. Is it just that I need more lighting or is it okay?
It's okay.
I think it's good.
It's okay.
All right. So, and I will, like I said, it came in at 8 o'clock last night. So my husband and I were putting it together and it was, of course, in 100 parts. You would have interest expense. Does that make sense?
Mm-hmm.
All right. So
Is there a way that I can make it so like the screen stops switching so yours stays big? Because it keeps like switching between people on mine for some reason.
oh, does it? Okay, let me
If
see.
you're in speaker view and then you go over her video, there's like the 3 little dots in the right corner. You can pin the video.
Okay, perfect. Thank you.
Does that help?
Yes. No, well,
Yeah.
does it help y'all?
Yeah.
Okay, cool. So thank you for helping me with that. You know, I'm not as tech savvy as y'all are just because of age, but I thank you for helping with that. So is that better? Everybody can see just me or, okay. So now on the other hand, if we have accrued revenue, remember accrued revenue means that we've earned the revenue, but we're going to get the money later. And so we know that that's going to generate a receivable. Well, if the customer pays 1 year after the revenue is earned, then think about that kind of a transaction. If I have earned revenue, but the seller is not going to get the revenue until a year, get the cash until a year after they have earned the revenue, then the seller would have interest revenue, because in essence, they have loaned the customer the money. I earned the revenue, I pass control of the revenue to you, but you're going to take a year to pay me. So then embedded in that transaction price would be interest revenue. And those are the concept is discussed on page 295, and the calculations are on page 296. Again, I won't ask you to do the calculations, but looking at them helps you understand the concept, okay? But so the same concept we're going to be looking at, and as you read about the notes receivable in chapter 7, it's based on this concept, okay? Does everybody understand that concept? So we would have part of the transaction price would be interest revenue, because in essence, the seller has loaned money to the customer, and therefore, because of the time value of money, would be earning interest. Make sense? Okay, so now I want to get into chapter 7. I can't flip this board. I did buy oh, I'm erasing it. Did everybody get it? I can repeat it if you didn't get it. Now this thing's on rollers, so. All right, now we're going to talk about chapter 7. And before I get up on the board, the first part of chapter 7 talks about cash and cash equivalents. Y'all remember that? What's a cash equivalent? You remember it from chapter 3 in the balance sheet when we were doing a classified balance sheet? What's the definition of a cash equivalent? Pardon me? Remember, the cash equivalent is investments that are purchased, and the time period between the purchase date and the maturity date is 3 months or less. Y'all remember that? Like a treasury bill? Okay. So this is just reminding you about the difference between a cash equivalent, and then of course an investment. Remember, we could have short-term investments if they didn't meet the definition of a cash equivalent, and or a long-term investment depending on when the maturity date is. So do y'all remember that in chapter 3? Okay. So that part of the chapter we're good with. The internal controls section of this chapter, internal controls in accounting are of paramount importance. You can see that. What are the 3 objectives of internal controls? What are the 3 objectives of internal controls?
To decrease theft and fraud is one of them, right?
Okay, right. Well, that's one of them. If you look, that falls in the one that's about reliability of financial reporting. The reliability of financial reporting. Okay, so there are 3 objectives that internal controls have. And go ahead.
Effectiveness and efficiency of operations.
Right, that's it. So about efficiency of operations. You can imagine management and the controls that they need to put into place so that information goes upward so that they can make the decisions that they need to do based on the operations. Okay. It also, what's the second one?
Reliability of financial reporting.
Okay, good. Reliability of financial reporting. And boy, as accountants, are we interested in that, right? And Katone, that's where we get into that we need to have prevention and detection of fraud.
Right.
That their internal controls need to prevent and detect fraud or errors and fraud, sorry. Prevent and detect errors and fraud. And then, of course, the third one is they need to have system in place to make sure that they're in compliance with all laws and regulations. And speaking of laws and regulations, the UT attorney has told us all that I have to tell you or inform you that this is being recorded. So I've done my legal part for the compliance with laws and regulations. So that's what internal control is. There's an organization called COSO, C-O-S-O. And as accounting majors or finance majors, I encourage you to go to coso.org. And you don't need to get into it in this class. When you get into Accounting 351, which is Dr. Walter's AIS class, you will be learning a lot about the COSO internal control framework. It's just a really nicely done document. It's actually the internal control framework that Sarbanes-Oxley recommends that companies use one that is of that same type of framework. In other words, they endorse the COSO internal control framework. Now, one of the control procedures for reliability of financial statements, we're going to get, I do want to talk about here because it is probably one of the most important internal control activities. And one of the activities is the separation of duties. And you can read about the separation of duties on page 341. Now I'm going to go to the board, and for the separation of duties, I just have students remember the acronym ARC, A-R-C. Can everybody see the board okay? Do I need to move it closer?
Oh, it's okay.
Okay, so the ARC, and there are 3 incompatible functions. The person who is in charge of authorizing a transaction should not also be responsible for recording the transaction or have custody of the asset. So I'll often give the example here. Those are 3 absolutely incompatible functions. You need to have 3 different people doing this activity. Imagine if you worked in a warehouse where all the inventory is. So you have custody of the asset. And, pardon me? You have custody of the asset. Well, if you can also authorize a transaction, then you could seal the inventory, authorize a transaction that inventory fell off the shelf and is, broken, and then the company would have to debit cost of goods sold and credit inventory. So you can see there where if I can authorize a recording, recording means doing the journal entry. You can authorize a journal entry, then you could steal assets from the company, authorize somebody to do the authorization and do the journal entry in order to get it off of the books. So these are considered, on your separation of duties, one of the big control activities that is part of that COSO internal control framework. So I just want to focus on this particular one with keeping in mind about these internal control procedures. I know that they discussed them about cash receipts and about cash disbursements, so that you can read about the importance of ARC, the separation of duties for cash receipts and cash disbursements. We learned in chapter 3 also about restricted cash. Remember, we could have some cash that is dedicated to paying off bonds later on, where the company is having to save money every year into a restricted cash fund where it's cash that they can't use. It's restricted for a special purpose. And we know that, for example, if it is cash that is being put into a savings account or a money market or whatever kind of investment they want to put it in to save for a bond, and that bond is due in 10 years, then that restricted cash would be reported as a long-term asset. This is, again, going in conjunction with what we learned in Chapter 3. The compensating balances, you can read about compensating balances and what they are. Many banks will require that either you as an individual, in order to earn interest on your checking account, or for companies, it could be that in order for them to maintain a line of credit with the company, that they have to maintain a minimum balance in their checking account, that their checking account can never go below a certain balance. You can read about the compensating balance in that if the company borrows money from the bank, and the bank says, well, if you keep $100,000 in your account, then your interest rate will be 6%. If your account falls below the 100,000, then your interest rate will go up. So when we have compensating balances, that means that we don't have use of that money. So it's going to have an interest effect on us. And it makes the effective interest rate of our note higher if the compensating balance is linked to a note. Okay. Again, I don't get so much into the number crunching of this as I do is understanding that if the bank is telling me that I can't use this $100,000 that is mine, then because I've borrowed money and I must maintain this minimum balance, then it effectively increases the effective interest rate of that loan. So hopefully y'all read that last night. Now, accounts receivable. You learned in principles, and I know y'all get tired of hearing that, but you learned in principles about accounts receivable. Now, what is accounts receivable? Can y'all hear me okay? Can y'all hear me okay?
Can you talk about the comprehensive balance right on the board?
Pardon me? Who is?
I
Liam?
am
Look at Liam. Can y'all see Liam? Liam's got some kind of there. Oh, there he is. Didn't have a space up there. I'm like, Liam, what you got going on? Okay, who's asking a question?
what it is.
Hello, how are you doing, Miss Pham? What is your question? Okay, I'm sorry. I thought somebody had a question. So now let's get into accounts receivable. And what is accounts receivable? Come on, we know this. This is simple. What is accounts receivable?
I can't hear you.
Oh, you can't hear me? Are you muted? You can hear me now?
Yeah.
Okay, good. Because I did purchase, geez, I'm getting all sophisticated here, but I haven't linked it yet. It just came in last night. So if I need to start using the headset when I'm on the board, I will as soon as they just are getting charged. And then, anyway, I just got them last night too. So I will go to a headset next week if that improves the audio. So what is accounts receivable?
The cash that you're waiting to receive.
Okay, great. So accounts receivable is what is owed to the company. So accounts receivable represents what is owed to the company. Now, one of the things that we know about accounts receivable is everybody going to pay us?
No.
No. we're going to have some bad debt expense. So GAAP requires that if we know that we're not going to collect part of our accounts receivable, then we must establish an allowance for uncollectible accounts. Okay? Because go back to chapter 6. How much revenue are we supposed to recognize? We're supposed to recognize, remember the when and the how much? The when is when there's been transfer of control. The how much is how much do I expect to collect? How much do I expect to collect? Okay. So because GAAP requires us to report accounts receivable at the amount that we expect to collect, we have to establish an allowance account. And I'm just going to abbreviate it. It's called the allowance for uncollectible accounts. It can also be called the allowance for doubtful accounts. And we're going to create an allowance account. And the allowance account represents the amount, the company expects not to collect. Okay, so we've got to create an allowance for uncollectible accounts that represents how much of accounts receivable does the company expect not to collect. Okay. Now, before I finish this, if you go to page 346, and 346 is about sales returns. And we know that customers come in, they buy stuff, and then they return it. And what is the journal entry when a customer returns goods?
Debit, sales returns, credit cash.
Well, we would debit sales returns and we would credit cash if they had paid cash.
Right.
If they still owed us money, what would we credit? So if they owe us less money, what would we credit?
Accounts receivable.
Accounts receivable, great. So if it's a sales return, you're going to debit sales returns, and then you're going to credit either a cash liability if you don't pay them right then and there, or credit cash if you pay them, or if they still owe you for what they've returned, you would credit accounts receivable. So one of the things that you learned in chapter 7 is on page 346, where it talks about sales returns. Look at the top of page 347. So look at the top of page 347. And at the top of page 347, it says, and I don't normally read to y'all, but to avoid overstating revenue and net assets, the seller should reduce revenue for all returns in the current period sales, including those that occur in the current period, as well as the seller estimates will occur eventually. Now, what does that mean? That means that it's 2019. And in 2019, I'm making sales. And customers are returning stuff to me. And I'm debiting sales returns. What kind of an account is sales returns?
A contra revenue account.
Beautiful, a contra revenue account. Okay, sales returns is a contra revenue account. Okay, so we'll be taking a look at that. It reduces your revenue. So we would debit sales returned, a contra revenue account, and then as we said, if they've returned it during the year, we credit cash, or we credit accounts receivable, depending on how they paid us. Now, it's the end of the year. Let's say that our year is December 31st. And it's December 31st, 2019. And in December, we sold a bunch of stuff. What happens in the United States in December? What's going on?
Christmas.
Christmas,
Holiday.
right? People are buying a lot of stuff. Now, do you think that some of that stuff is going to be returned in 2020, in January of 2020? So what GAAP says we have to do is we have to estimate how much of this year's sales, meaning 2019 sales, how much of this year's sales are going to be returned in 2020. So we need to estimate how much that is. And when we do, we're going to, of course, debit sales returns. And we're going to credit an account that, if you look at the illustration 7.4 on page 347, I assume, has everybody gotten their book or their e-text where you can split it on the screen? Okay. So you can see that if they paid in cash, you will credit a refund liability, which is a liability account. We can also credit, if you look on page 348, that if they did not pay us in cash and they still owe us for it, in other words, what they're going to return in the ensuing year, the amount that we're going to estimate, and it's still in accounts receivable, then instead of crediting refund liability, we credit refund liability for those that paid in cash. But for those that we estimate that are still in accounts receivable, we have to credit an account that is a reserve account for sales returns. And you see this account, well, where's the name of the account? Anyway, it is an allowance for sales returns is the name of the account. You will credit an account called allowance for sales returns. Okay. Now this textbook has you doing the refund liability because that's assuming that you're going to be paying in cash. If it's in receivables, the part that you think is in receivables, we need to debit sales returns, which is a contra revenue account, going to reduce revenue, but we also need to credit an account that's called allowance for sales returns. So I'm going to subtract an allowance for sales returns. Okay. So here we've got accounts receivable, which is what is owed to the company. Then we need to subtract from accounts receivable the allowance for uncollectible accounts, the amount of accounts receivable that we expect not to collect. And we were going to work on a problem of how we estimate that. Then we've got to subtract the allowance for sales returns to reduce, because remember, what we need to report on the balance sheet for accounts receivable is the amount that we expect to receive. So if I expect that customers aren't going to pay me, or I expect that customers are going to be returning goods that they purchased this year, next year, then I need to create this allowance for the estimated amount of sales returns that I expect to get from this year's sales next year. So what kind of an accounts are the allowance for uncollectible accounts and the allowance for sales returns? First of all, what kind of a balance would they have, a debit or a credit?
A credit.
A credit, good. They would have a credit balance. Good, Elise. They would have a credit balance because they are reducing the amount of our accounts receivable that we expect to receive. So they're going to have credit balances. We debit sales returns, we credit the allowance for sales returns. So there's your credit. We're going to see that when we estimate how much we expect not to collect, that we're going to debit bad debt expense and we're going to credit the allowance for uncollectible accounts. So both of those accounts are contra assets. Now we know if it's a contra asset that it's linked to another account. What are these two contra assets linked to?
Accounts
Accounts
receivable.
receivable.
Accounts receivable, nice job. So once I take accounts receivable minus the two allowances that I've created, we end up with net accounts receivable. Net accounts receivable. And net accounts receivable equals our net realizable value, the amount that we expect to collect. Okay? So what we're going to focus on today is how do I calculate the allowance for uncollectible accounts? I forgot to mention in Blackboard just this morning, because you remember I lost all my data, so I'm having to retype a lot of things. In course content information, this morning I uploaded a note page on this chapter. Okay, can y'all access that? All right, so go into course content information and you should see, I knocked over my table, so my other table, you should see a sheet that is 2 pages. The first page is accounts receivable, and then the second page is notes receivable. We will be addressing notes receivable on Tuesday of next week. Today, we're going to focus on accounts receivable. So you should see this worksheet, this chapter notes page, where I've kind of summarized the 3 transactions that happen in the allowance account. Okay, so the first thing is, I'm going to erase this thing again. Where'd my eraser go? You know I'm always looking for something. So there are three primary transactions that happen. There are 3 transactions, economic activities that happen that affect the allowance account. And we're going to go through them. And if you're looking at the sheet, you will see the 3 as, do you see where it starts that the journal entry to record bad debt expense? That is the first one. So the first one we need to do is record bad debt expense. And when we record bad debt expense, we're going to debit bad debt expense, and then we're going to credit the allowance account, and this is the allowance for uncollectible accounts. So that is the allowance for uncollectible accounts. Again, you can see it on the sheet. I'm writing it on the board also. So there are 2 ways that we can estimate the bad debt expense. What were those 2 ways that you read about? What approaches?
The income statement approach and the balance sheet approach.
Nice job, Jacqueline. So we've got the income statement approach and the balance sheet approach. Often companies will use a combination of both. What they do, and we'll take a look at I believe it's problem 7.1 that we'll take a look at. But what they will do is they will use the income statement approach during the year, and then at the end of the year, when they're doing their financial statements, they will do the balance sheet approach. The balance sheet approach means that the company, look on page 352, look on page 352, that the company will estimate the allowance account for uncollectible accounts by doing an aging of the balance sheet, thus the balance sheet approach, an aging of the accounts receivable, which is obviously on the balance sheet. So they're going to age the accounts receivable. Do you see illustration 7.7? So in illustration 7.7, we had a company that had $305,000 of accounts receivable. Does everybody see that? And they aged it. They said, how old is this invoice? If I'm preparing this at December 31st, how many days are there between the invoice date, the date that the revenue was earned, and the balance sheet date, December 31st? And so they age it. And this particular company chose the aging brackets of 0 to 60 days, 61 to 90, 91 to 120, and over 120. And they aged them, and they said 220,000 is 0 to 60, 50,000 is 61 to 90, and then you can see across the board. Now, if I add up the 220 plus the 50,000 plus the 25,000 plus the 10,000, does everybody see where I'm getting those numbers from? What do you think you'll get?
The 305.
Perfect, the 305. So that is how the 305 has been aged. That's been how the 305 has been aged. Now, when you look at the bottom after that, they're saying of the 0 to 60 day old invoices, that 220,000, that we estimate based on history. This is something that you would be given because you're not going to be able to estimate, but the percentage. But the company will have a percentage that, based on history, that they expect of that amount not to collect. So they estimate that they're not going to collect 5% of those that are 0 to 60 days old. So when you multiply the 5% by the 220,000, you get the 11,000. Then of the 50,000 that was 61 to 90 days, they expected that they wouldn't collect 10% of it. And they multiply it and got the 5,000. And then I think you can see how it's done for the rest of them. So once they multiplied that percentage for each of the aging groups, they added it up and they got $25,000. When you're doing the balance sheet approach, we have now analyzed our accounts receivable, which is on the balance sheet, thus the balance sheet approach, and we've estimated that of the 305,000, that I am not going to collect 25,000. So as you look at the notes that I have, this sheet that I had uploaded for you, you can see, I put it in all caps, I'm screaming at you, that is what you want the adjusted balance of your allowance account to be. So in order to determine how much I need to debit bad debt expense for and credit the allowance for depends upon what is the unadjusted balance of the allowance account. Okay? So when you look at, this company that they had, I believe this company was the first year of operations, and so they had a 0 balance in the allowance account. So they debited bad debt expense, credited the allowance for the $25,000. Now this is only going to happen that the amount that you want your allowance account to end with. In other words, your adjusted balance will be the same number as what the adjustment is for, as if your allowance account has an unadjusted balance of 0. That's only going to happen in its first year of operations. Okay? So when you look at page 353, in the example that they had, they estimated that they would not collect $40,000 of their accounts receivable. Okay? And the unadjusted balance of the allowance account was $11,200. So the journal entry, in order to record the bad debt expense, in order to get the allowance account to the $40,000, they had to debit bad debt expense and credit the allowance for uncollectible accounts for $28,800. Okay? Everybody understand that?
Where is the 28,800?
All right, the unadjusted balance is $11,200.
Okay.
All right, and I want the ending balance, the adjusted balance of the allowance account to be $40,000. When I did the aging, I determined that the adjusted balance of the allowance account should be $40,000. So to get the $1120 to the $40,000 requires an adjustment of $28,800. So now you see why I put it in all caps, screaming at y'all that, you know, the amount that you want your allowance account to be is not the amount that the entry is for. The entry is for whatever it takes to get the allowance account to what you calculated it that you wanted the adjusted balance to be. Does that make sense?
Okay.
The second transaction, and if you're looking at the sheet that I gave you, the second economic activity that we see in the allowance account is, what if we have a specific write-off? Remember, we've established this allowance account and we don't know who is not going to pay us. We don't know particularly who's not going to pay us. So once the person raises their hand and says, I'm the one that's not going to pay you, now they're of course not literally raising their hand, but the invoice is really old. I've been trying to call them. The phone is disconnected. I've been sending statements through snail mail and they're not responding, or it's coming back saying that they're no longer at this address. I mean, there's something that's saying, ding, 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 I'm not going to collect this money. Or I get a bankruptcy notice in the mail on a customer. So once I know a specific customer that needs to be written off, the journal entry is, so the second one is a specific write-off. A specific write-off. And when we have a specific write-off, we do the journal entry of, where are my, well, where's my specific write-off? Does anybody see it? Where am I missing it? Oh yeah, it's on page 351. So do you see the subtitle that says when accounts are deemed uncollectible? On page 351. That is your specific write-off. And what we do is we take them out of the allowance account. Now, how would I reduce the allowance account? Debit or credit?
Debit.
Debit, good, because it has a credit balance. So I would debit the allowance for uncollectible accounts and I would credit accounts receivable. I am removing them out of accounts receivable because I know which specific customer it is, and then I take them out of the allowance account. think of the allowance account as a pool of, we don't know specifically who, it's just a pool of money that I have estimated that I'm not going to collect. I don't know who, but it's just a pool of unidentified non-payers, okay? Once I have a payer identified that's not going to pay me, I need to take them out of the allowance account and I need to take them out of accounts receivable. Now, what effect did this have on net accounts receivable? Did this change net accounts receivable, this journal entry? No. It just moved it out of the allowance and out of accounts receivable. One's a debit, one's a credit, so it has a net effect of 0 on your net accounts receivable. Okay. Now, the third thing is, and this is at the bottom of page 351, and again, it's repeated as the third, 1, 2, and 3 I've summarized here. The third activity in your allowance account is recovery of a previously written off account. Okay, so we wrote off an account and we debited the allowance account and we credited accounts receivable. And lo and behold, a month later, a year later, 10 years later, it doesn't matter how long later, it doesn't have to be in the same year that you wrote them off. All of a sudden you get a check in the mail from this customer, they either, got a job. Maybe they didn't pay because they lost their job. They got a job, or they inherited some money, or they won the lottery or something, and they now have the money to pay their creditors. So I get a check in the mail. We see that there are 2 journal entries that are done when we have a recovery. The first thing is reverse what you did when you wrote them off. You see that the first entry at the very bottom of page 351, it's about to fall off the page, is you debit accounts receivable and credit the allowance account. You're just reversing. Can you see the bottom of that? You're just reversing what you did when you originally wrote them off. Can y'all see that? No. Okay. Again, it's on your sheet. All right, so you just reverse what you did. And then you just do the journal entry. Look at the journal entry. Then you just do the journal entry of what do we do when we have a collection on account? What journal entry do we do when we have collection on account? Come on, this is easy. We got cash, so what are we going to do?
Debit cash.
Good. And credit what?
Accounts receivable.
Good. So we will, so the second journal entry is debit cash and credit accounts receivable, just like we do when we have any cash collection. Okay. Can y'all see the bottom part?
No.
All right. So I may move to another room. I don't know, depending, this room is the best room so far, but I'm describing everything that's on here. So recovery of a previously written off account, we first debit accounts receivable and credit the allowance, and then we debit cash and credit AR. Okay, those 2 journal entries. So now, because of the critical, this is what you learned in 202. Does anybody have any glimpse of memory of this? Okay. So now, we've got that critical thinking part. Let's take these activities and let's look at the T account of the allowance account to see what's happening. Okay. So, let me make this still before I So the allowance account, when I look at the T account on the allowance account, of course, it's going to have a beginning balance and it's going to have an ending balance. Notice it's on the credit side because it is a contra asset account. Okay. Now, in the first journal entry that we did, where we had to recognize what is bad debt expense for the year, what did we do to the allowance account, debit or credit?
Credit.
Credit. So we know that the allowance account is credited for the amount of bad debt expense. For the amount of bad debt expense. Now, when we have a specific write-off, what happens in the allowance account? What do we do to it?
Debit.
Good, we debit the allowance account. So I know that the allowance account is debited for a specific write-off, Now, the third economic activity that happens in the allowance account is recovery of a previously written off account. What happened to the allowance account when we had a recovery?
Credited it.
Good, we credited it. So we know that the allowance account is credited for any recoveries that we had. Okay. So once we understand what's happening in the T account, remember, understanding the throughput through the T account. Do you remember yesterday or Tuesday when we had the CIP account? And the first thing that I asked you to do was understanding the concepts of what goes through the account. That I had you draw a T account and write the words in it, that we debit the CIP account for actual cost and then gross profit and credit it for gross loss so that we know what's in that account. And that helps you with those more critical thinking questions that you have. For example, go in Blackboard. And in Blackboard, in the same place where you find the accounts receivable notes page, I've got, it should be called something like Chapter 7 Excel homework. Do you see that problem? What I go to, we're going to work some of these in class, you'll work some on your own, but go to problem number 6. Go to problem number 6. This is the type of critical thinking that we do. This is bookkeeping that we learned in principles. Now let's put our intermediate hats on. Now we're becoming accountants. And look at problem number 6. And take a few minutes and, Liam, what's happening with your, are you hot? I can't hear you, you're muted. I saw you fanning your computer. Oh, it doesn't matter. So take a look at number 6. And take a few minutes and work number 6. Let's put that critical thinking hat on. And I want each of you working number 6. Now, a hint, T accounts are your friends. So what I am looking for is what should the company report on its balance sheet as accounts receivable before the allowance for doubtful accounts. Okay. So I'm going to erase this. I want y'all working on it. And we've got to utilize the tools that we just covered today. We know that what's reported on the balance sheet is accounts receivable minus the allowance for uncollectible accounts minus the allowance for sales returns. Well, this problem doesn't address sales returns, so we know that what should be reported on the balance sheet for this problem is accounts receivable minus the allowance account. So what two T accounts are you having to work with? What two T accounts are you having to work with?
Accounts receivable and the allowance.
Good. So you need to do an analysis of accounts receivable and the allowance. Good, Aaron. Now, what is going to be the beginning balance for each one of the accounts? What's going to be the beginning balance for each one of the accounts?
0.
0. Why?
Because it's the first year of operation.
Very good, Jacqueline, because it's the first year of operations. So then put in the amounts of information that you were given and then apply the concepts that we know. Lillian, you look so comfortable.
I am.
Good. Good. If you got to be at 8 o'clock on an online class, you might as well make it comfortable, right?
Well, my family's loud, so I just gotta stay upstairs.
And they're awake
We have 2
already.
dogs too. They just bark all the time, so we're gonna stick to upstairs for now.
Yep. I don't blame you. We have an upstairs to our home that used to be my son's room. It's a big bonus room, and it was my son's bedroom. That's Robert, the one that is living in Chicago. And since he moved out, I was going to make it a big office. And for some reason, it has turned into an attic. Everything is like, oh, put it upstairs. Oh, put it upstairs, because nobody goes upstairs. Well, I told my husband, I said, now you see why I wanted this to be an office? Because right now, that would be my jamming studio instead of your hobby room. All right, so did anybody get an answer? And it doesn't matter whether it's wrong, let's just attempt it. So what would accounts receivable be on the balance sheet? Takes some thinking, doesn't it? All right, so you want me to help you and show you? All right, so let's do this. The first tool that we know is I'm going to use the accounts receivable, and I've got my allowance account. I know the allowance account had a beginning balance of 0, and the accounts receivable had a beginning balance of 0. And we learned that at the close of the first year of operations, that Lynn Company had accounts receivable of $440,000. Oh, excuse me. It had accounts receivable of $440,000 after deducting the related allowance for doubtful accounts. Okay. So over here, can you see here? So accounts receivable minus the allowance account, which equals net accounts receivable, is $440,000. Okay. So it just said that accounts receivable after deducting the related allowance, which we know is net accounts receivable, is $440,000. Then it says during 2018, the company had $120,000 of bad debt expense. What am I going to do with that? Bad debt expense affects which one of these accounts? The accounts receivable or the allowance?
Allowance.
Good. Now, when we have bad debt expense, is the allowance account debited or credited?
Credit.
Credit. So I know that my allowance account had $120,000 credit. This is applying our basic knowledge. And it wrote off during the year 80,000. So what happened when we write off an account? What is that journal entry?
Allowance.
Okay, we debit the allowance. So I'm gonna debit the allowance for 80,000. And what did I credit?
Accounts receivable.
Accounts receivable. Okay. There were no recoveries. It didn't say anything about recoveries. Right. So recoveries would have been 0, and they would have been a credit to the allowance account, right? So now, what is the ending balance of my allowance account? What is the ending balance of my allowance account? Pardon me?
1,000.
Right, so the ending balance of my allowance account is going to be 40,000. Okay? So now I know the ending balance of my allowance account is 40,000. So what did accounts receivable have to be? I'm trying to draw a line here. So if net accounts receivable is 440,000, my allowance is 40,000, then what did accounts receivable have to be? What was the ending balance of accounts receivable?
480.
480. I didn't need, so this is 480,000. I know I've got numbers scrunched up here. I'll get used to the size of the, and I bought the larger size whiteboard. I bought the $200 version instead of the $150 version. So 480,000 is what would be reported as accounts receivable. You really didn't need to analyze the accounts receivable account, but I wanted to put it up there just in case, because we know that we were trying to look for what the allowance, what accounts receivable should be. Okay? So this is why it is important to understand how economic activities affect your account. So was that one hard? I see scratching heads like, So now that you've seen how we have applied it, this is where you need to apply the knowledge that you know. You know that accounts receivable minus the allowance equals net accounts receivable. And it told you that net accounts receivable was 440,000. Then it gave you enough information for you to calculate the ending balance of the allowance account, which was 40,000. So then we work backwards. I know that the net amount plus the allowance will give me my accounts receivable number. Okay. So this is the application that we do in intermediate. Are we good with this? Okay. T accounts are your friends. T accounts are your friends. Okay, so that was question number 6, where we're applying the concept of we understand what is going on in the allowance account. Okay, we understand what's going on in the allowance account. Look at question number 1. And if you want to pull up Excel, you can do it by hand, as we would do, either by hand or in Excel in class, whichever is easier for you. Look at question number 1. Now, question number 1 is like the illustration that we did on page 352, where you first have to determine what should be the ending balance of the allowance account, and then do the journal entry to record it. So go ahead and work on that problem. Does everybody have this? If not, raise your hand. Okay, Ms. Pham, you don't have this information?
Yeah, I have this information.
You have it? Okay, so I'm gonna go ahead and erase it while you work on that problem. I see you can take screen pic shots if you want. Y'all know how y'all can, welcome to do that. Are you texting or taking pictures, Liam?
I'm on a calculator.
Oh, you're on the calculator, got it. I didn't know if I could erase this or not, is what I was waiting on. All right. So what is the first thing that you're doing? What's the first thing that you're doing? Tanisha, what are you doing?
Finding the allowance.
Right, so you're multiplying the amount of in each aging by the percent?
Yeah.
And then totaling it down, good. So has anybody calculated what should be the adjusted balance of the allowance account? I don't know if y'all are hearing the noise outside, but our next door neighbor's getting a new roof on their house today, so I got that noise to listen to. So did anybody get to it yet? Clayton, how are you doing with this?
I'm doing fine.
Okay, great.
My Wi-Fi like cut out, so I just got back on, but like the video chat stopped for me for a second, and I was like couldn't figure it out. But I looked down and like my Wi-Fi just wasn't on, so.
Oh, that was like before I didn't have my voice, I had the volume off on my, really, I'm like, okay, that's why I can't hear y'all, so.
Yeah.
Make sure your Wi-Fi's on. All right, so we're working number one in that problem. Do you see, Leighton, were you able to get the problem off of Blackboard?
Yeah, I'm trying.
Go into Blackboard and you'll see that under the Chapter 7 notes, there's two files. One is the note page, then the other one says, I think, Chapter 7 Excel homework. That's the one that we're working on, the Chapter 7 Excel homework.
Okay.
All right. So what did y'all calculate? You know, once you multiplied 420,000 times 2% on down, what did you get as what the ending balance of the allowance account should be?
49,400.
Perfect, Taylor. So 49,400. So I know that my allowance account should end with a balance of 49,400. Should end with the balance of 49,400. Now let's look at the information that it has given us about the allowance account. It says during 2019, Rosser wrote off 48,000 in receivables. Now, what do we do with that? When we write off an account, what is our journal entry?
Debit allowance.
Good, we debit the allowance and then we credit. What account do we credit?
Accounts receivable.
Good, accounts receivable. But right now we're focusing on the allowance account. So we know that the allowance account was debited for 48,000. We know that the allowance account was debited for 48,000. And then it said it recovered 6,000. So when we recover an account, what happens to the allowance account? Do we debit?
Credit it.
Good, we credit it, because looking at the T account where I put the economic activity names in it, recovery is on the credit side. So I know that the account was credited for 6,000 during the year. Using the what amount of allowance for uncollectible accounts should Rosser companies report at December 31st, 2019? Now, I didn't give you where did I say what the beginning balance was?
It says.
Oh yeah, I'm sorry, there it is. So at December 31st, 2018, remember we're working in 2019. So if the ending balance of 2018 was 40,000, then that means that the beginning balance at 2019 is how much?
40.
Good. So I know my beginning balance was 40,000. So what is the unadjusted balance? How am I going to get, what is 40,000 minus 48,000 plus 6,000? What do we get?
Negative 2,000.
All right, so we get a $2,000 debit, right? Isn't the debit side higher than the credit side? So our unadjusted balance is a debit of $2,000. And we'll talk about how this can happen in just a minute. I want y'all to think about that. But before we do that, let's finish this problem. So it has an unadjusted balance of a debit of 2,000. So we calculated that the allowance account should end with 49,400. So how much is my bad debt expense? Remember, this is your beginning balance. This is your ending balance. This was your recovery. This was your write-offs. So the only thing missing is bad debt expense. So how much would my bad debt expense be? What would I do the journal entry for?
51,400.
Perfect, 51,400. So I would debit bad debt expense and credit the allowance account for 51,400. Okay, because I had a $2,000 debit that needs to be a 49,400 credit. So I'm going to have to credit the allowance account and debit bad debt expense for the 51,400. You see how we're using T accounts to analyze, to get where I need to be. Okay, do you have a question? Okay, questions about this? Go ahead. Somebody have a question? All right, so does everybody understand how we got the 51,400?
Yeah.
All right, now, how could I end up with a $2,000 debit balance? What happened? How did I end up with a $2,000 debit balance? Well, look at your T account where you wrote in the economic activities. You know, the T account where you have beginning balance and ending, and then you have, when is the allowance account debited?
When you write something off.
Good, Aaron, when I write something off. So if I ended up with an unadjusted debt balance, then that means that I wrote off more than what I had estimated. Does that make sense? Okay, so I wrote off more than I estimated. That's going to happen. Do we ever estimate perfectly? No. Sometimes it'll be an unadjusted credit balance because we had underestimated, or when we end up with a unadjusted debit balance, then that means that we had underestimated. We don't need to do anything to correct it. It's just an estimate, and then we just go forward. Okay, so the bad debt expense for this year is higher than what I estimated the allowance account to be because I had underestimated last year. Okay, makes sense? All right. So that was a problem with going through how do we calculate the amount of bad debt expense? This is the balance sheet approach. This is the balance sheet approach. Okay. How we doing so far? Thumbs up, thumbs down.
Dr. Bobbitt,
Yeah.
can you go over please how you got the 51,400 on the T account?
Yeah. So do you see how I've got a $2,000 debit?
Yeah.
And it needs to go to a 49,400 credit.
Right.
So I need to add.
Okay.
Right. Because I got to get a debit to a credit.
Right. All right. Thank you.
Now, what if this was a $2,000 credit balance? What would my adjustment have been for?
47,400.
Perfect. Perfect. Okay. All right. That is the analysis of the allowance account itself. That's the analysis of the allowance account itself and accounts receivable. This took care of pages, on page 350 is the direct write-off method. We will not learn the direct write-off method. It is not GAAP, and I don't teach it. Smaller companies where they don't have a lot of accounts receivable use this method, but it is not GAAP. So we're not going to learn or have anything on the direct write-off method. Okay, we must use the allowance method in GAAP. Now, on page 4, they talk about the combined approach. And this is what I was talking about earlier, where companies may use the income statement approach to estimate bad debt expense during the year, and then at the end of the year, in their final financial statement that they're going to report to the public, then they switch to the balance sheet approach. The income statement approach is real simple. The company estimates how much of their sales do they expect will be bad debt that they will collect. And this is based on history of the company, within the company. And so they apply that percent to net sales for the year or net credit sales to the year. And that is what they debit bad debt expense for and credit the allowance account. And then they switch to the balance sheet approach at the end of the year. Problem oh, that's exercises, no wonder. I thought it was problem 7.1. Let me get there. Yes, question? This one's full of extra. Yeah, the problem 7.1, which is on page 390, is an example of the combined approach. The solution to this is uploaded into course content information. So that's one of them to practice. That's one of them to practice. Problem 7.2. Problem 7 is another one that is an application like the one that we had as number 6 in here. So those are really good problems to work. Problem 7.1, 7.2, and 7.3. Anyone that I've uploaded the end of chapter solution for are good problems to work. It's not like I've just uploaded arbitrary solutions. I have gone through and picked the ones that are best for you to practice for understanding this material and, of course, the exams. Okay. So how are you feeling with the activity in the allowance account, analyzing the allowance account, and then applying the concepts?
Pretty good.
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 Also in course content information on Blackboard, do you see that I've got a bunch of files uploaded that are practice problems?
Yeah,
All right, those are both for accounts receivable and for notes receivable. Okay, those practice problems that I've got uploaded. Because notes receivable, you can see is a more difficult, is the more difficult part of this chapter. And if you look at the second page of the notes page, we learn in chapter 7 that there are 2 types of notes receivables. One is an interest-bearing note. Is it almost class time? Or we have another hour?
We have 10 minutes.
10 minutes. 10 minutes.
All right. So for Tuesday, we're going to focus on the notes receivable. It's much more difficult than this accounts receivable part. There are 2 types of notes receivable. One are the regular interest-bearing notes receivables. You should be familiar with these. Again, you learned these in 202. Take a look at them, practice them, so that when we go over them on Tuesday, that it's a reminder. Because the ones that we need to spend the most time on are the ones that have what are called non-interest bearing. They're not really non-interest bearing. It's just that they have a 0 stated percent. So the interest rate is 0. And so we know from the concept that we first talked about in the beginning of class that if there is a 0% stated rate, that we know that what's embedded in the transaction price is going to be interest revenue. Because remember, if we have a receivable and it is interest bearing, then we're going to have interest revenue, even if the interest rate is a 0% interest rate. If it's a 0% interest rate, then we know that that interest is embedded in the transaction price. You think about, have you seen the commercials where people are selling cars? I use this example all the time because they have them. And they say, come in and buy the car and we'll give you a 0% interest rate. So they're going to give you a 0% interest rate on buying the car. Now, are they really going to let you buy a car and pay for it over 3, 4, or 5 years with no interest? No. So what have they done in the contract? What have they done if it's going to be 0% interest? Where do they recoup that money? What's it in?
In the like than the transaction price?
And the transaction price and the selling price. They're going to sell you the car. The amount that you're going to actually pay for the car is going to be higher because in that transaction price, the selling price of the car is the embedded interest that they, because they're good business people, know that they're going to earn, right? Time value of money. If you're going to take time to pay me, I'm going to charge you interest. So make sure that between now and Tuesday that you take a look, that you practice some problems. You can see I've got quite a number of them uploaded for you, as well as look at the second page of that notes page that I've given you. And the second page of the notes page summarizes what's in the chapter. It is not a replacement for reading the chapter. It is just a summary of how to account for these two notes. Look at it so that on Tuesday when we meet, that you have an understanding of where we're starting in class, and that we're not starting with you having no knowledge at all. We can't come into class, whether it's in the classroom or online, without having read the chapter and done the SMART book. So do y'all remember in the SMART book addressing the non-interest bearing notes?
Yes.
Yep. And what do we have to do to them? We have to calculate what? The present value. You gotta have to calculate the present value of those notes, okay? So work the problems, those problems that I told you about accounts receivable. Work on your notes receivable that we will do on Tuesday. Then on Thursday, we've got a review day. It's rare that we've got a review day, but we do have a review day for exam 2. I will be putting up an exam 2 topical coverage so that you can start studying for it. This exam only has 3 chapters. Chapter 5, which is time value of money. That's just a tools chapter. Remember calculating bonds and calculating present value and future value. So the only accounting chapters that we have on this test are chapter 6, revenue recognition, and chapter 7, accounts receivable and notes receivable, which means that we've got to learn about the allowance account, which we did today. We need to learn about how to calculate the notes receivable. And then we also are going to take a look at what happens when we sell or factor our accounts receivable. Okay, y'all remember reading that part about factoring and selling your accounts receivable? So focus on those for us to start class on Tuesday, and we'll have some problems that we'll work together. I'm going to practice. I didn't do it today, but where I can put y'all into those breakout sessions so that you can work on problems together. We'll see how that works. If it doesn't work, we'll abandon it, okay? This class is small enough, the 8 o'clock class is small enough that we can continue doing it all together as one class instead of breaking out into breakout rooms where you can just hear one another, and then I can go into each breakout room to see how you're doing. Okay? All right, so we got the Blackboard. I'll continue working on the Blackboard spacing, of it or positioning of it so that you can see it better. Hopefully you were able to get something out of it today with the Blackboard and class. So again, I will be pushing out about extra credit for attending the live sessions. I do get a report of when you log in and when you log out, and then I will be sending out questions during the class period that will be multiple choice questions on what we're talking about. It won't be just what color is the sky. And for you to answer, that will then dictate how much of the extra credit points that you get. Okay? All right, so how are y'all doing all of your classes? Layton?
Huh?
Did you have a question?
No, it was me. What are we gonna do about the quiz this morning? Are we gonna?
Yeah, I will send out. I will launch it. I will launch it again. I'm gonna go in and figure out what's wrong. I created it last night. So right now I'm thinking that maybe it was on PM instead of AM.
Mhm. Okay.
I will go in, I will send out an announcement about when it will be relaunched, so that you can take it when I relaunch it.
Cool.
Okay. All right. So we're going to go ahead and end class today. And any comments on what I can do better, either, physically, with the board or helping y'all. I'm putting up as much as I can on Blackboard for y'all to practice and to do, and for us to work problems in class. Make sure that you do the end of chapter problems, that I've got the solution opened up so that you're staying prepared as we go along. Okay? I've got more office hours set up, and if you need me in between those office hours, email me and we'll set up an individual Zoom meeting. Okay? I met with a few students yesterday and it worked pretty well. Okay? So ciao, or I don't know if I ought to say ciao because Italy is shut down. So, right? Au revoir, peace out, right? So I will see y'all on Thursday. Email me if y'all have got any problems. And no, I'll see y'all Tuesday. And I will send out the announcement about what we'll do with the quiz. Okay?
That's good.
Hard.
Oh my.
Quite welcome. I miss y'all, but I'm so glad to see your faces. Logging out.
Have a nice day.
Thank you. And then, were y'all able to access the recording? Has anybody tried to access the recording?
Yeah, it would.
Like the one from your first class?
Yes.
Yeah.
Yeah.
Yeah, it worked?
Yeah, it did.
Yes.
Okay, good. I just wanted to make sure because I had it set on private and then it wouldn't work. And then hopefully I got it off of private and it is working. So you can always go back and relook at these, lectures that we're doing. And when I put up some that I'm just doing, like with y'all not in here where I'm demonstrating a problem, like I'll probably will do one on non-interest bearing notes. Then y'all can look at that one individually at any time. Okay? Ciao.